Charlie Munger was worth about $2.5 billion when he died in November of 2023, and almost none of it came from a lucky break. No single stock made him rich. No inheritance set him up. He built it slowly over roughly 7 decades, using a small set of rules he refined again and again until they became instinct. Most of those rules sound almost too simple the first time you hear them. That's exactly why so many people ignore them. They're looking for a secret formula, a hidden edge, some piece of information nobody else has. Munger's whole life argued against that idea. He got rich, and more importantly, he stayed rich by doing ordinary things with unusual discipline for an unusually long time. By the end of this video, you'll know what those things were, roughly in the order he used them, starting with the one rule almost every successful investor breaks before they even notice they're breaking it. Before the list, it helps to know who Munger actually was, because his path was stranger than most people assume. He didn't start as an investor. He trained as a lawyer, ran his own firm, and only began investing seriously in his 30s using spare capital on the side. He lost most of it more than once. In 1953, his marriage ended and he had almost nothing left financially. A few years later, his young son Teddy died of leukemia, a loss Munger later called the hardest thing he ever went through. Around the same stretch, a botched cataract surgery left him blind in one eye, in constant pain, and he chose to have the eye removed rather than live with it. Most people hearing that story would expect the next chapter to be about giving up. Instead, Munger rebuilt his finances from close to zero twice before he ever partnered with Warren Buffett. That detail matters because everything on this list came out of a life that got tested under real pressure, not a comfortable theory built in hindsight. Rule 1, and arguably the one that shaped everything else, was to invert the problem. Munger borrowed the idea from the German mathematician Carl Jacobi, who used to tell his students, invert, always invert. Instead of asking, how do I get rich, Munger asked what would guarantee he stayed poor or lost everything he already had, and then spent his energy avoiding those things rather than chasing the upside. It sounds like a small mental trick, but it changes how you approach a decision at the root. Most people spend their effort hunting for the brilliant move. Munger spent his making sure he never made the catastrophic one. Over 60 years, dodging catastrophe mattered more than landing brilliance, because a catastrophic mistake can erase decades of gains in one bad stretch, while a missed opportunity just means you compound a little slower. The second rule grew directly out of the first. Stay inside your circle of competence and know exactly where the edge of that circle sits. Munger and Buffett famously avoided most technology stocks for decades, even while the rest of the market chased them, because they didn't feel they understood the businesses well enough to have real conviction. People mocked them for it during the dot-com boom. Then the crash came in 2000, wiped out trillions in paper wealth, and Berkshire Hathaway walked away almost untouched. The lesson wasn't that technology was bad. It was that knowing the size of your own knowledge beats having a lot of knowledge in general, because it tells you exactly where to stop risking real money. Rule 3 was about incentives, and Munger considered it one of the most underrated forces in human behavior. Show me the incentive, he liked to say, and I'll show you the outcome. He thought people, even well-meaning, intelligent people, unconsciously bend their judgment toward whatever benefits them financially or socially. That belief shaped how he read every business he studied. He didn't just look at the product or the balance sheet. He looked at how the people running the company got paid, because a bad incentive structure could rot a good business from the inside long before the damage showed up in the numbers. Patience came fourth on the list, and Munger treated it less like a virtue and more like a weapon. He compared investing to baseball with one crucial twist. In baseball, if you don't swing at 3 good pitches, you're out. In investing, you can let thousands of pitches go by and wait for years if you have to, until the one opportunity you truly understand crosses the plate. Berkshire sat on enormous piles of cash for long stretches, doing seemingly nothing, while critics accused them of being asleep at the wheel. Then a crisis would hit, prices would collapse, and Berkshire would move fast and decisively, buying stakes in companies like Goldman Sachs during the 2008 financial crisis on terms nobody else could get, because they had the cash sitting ready and the patience to have waited for it. Rule 5 connects straight to that one. When a real opportunity does appear, back it with real conviction, not a token gesture. Munger criticized the habit of diversifying so broadly that even your best ideas barely move the needle. He preferred a small number of positions he understood deeply, sized large enough to matter, over a long list of mediocre bets spread thin in the name of safety. Some of the best investors in history, he pointed out, made most of their fortune from a small handful of decisions. Spreading your capital across 50 ideas you don't really understand isn't safety. Often it's just a way to guarantee an average result. Then there's the lattice work of mental models. Rule 6. Munger believed no single field of study, whether economics, psychology, physics, or biology, gave you a complete picture of how the world worked. Relying on one discipline, he said, was like a carpenter who only owns a hammer. Every problem starts looking like a nail. He read across dozens of subjects specifically to collect frameworks from each one, so that when a real decision showed up, he had several lenses to look through instead of forcing it into whatever model happened to be closest at hand. That reading habit was Rule 7 in its own right. Treat learning as a lifelong discipline, not something that ends after school. People who knew Munger described him as a walking book with legs sticking out. He read for hours every day, well into his 90s, across biography, science, history, and business. Intelligence without continuous learning, he thought, fades fast in relative value because the world keeps changing, and the people who stop updating their knowledge slowly go stale, even if they were brilliant 20 years earlier. Rule 8 was to hunt for evidence that could prove you wrong, not evidence that confirms what you already believe. Munger called confirmation bias one of the most dangerous default settings in the human mind, precisely because it feels like careful thinking while doing the opposite. He trained himself to argue the other side of his own position before committing serious capital to it, because he distrusted how easily a smart, confident person can talk themselves into a bad decision if nobody forces them to test it first. Nenth was studying mistakes, both his own and everyone else's, with equal seriousness. Munger thought learning only from personal failure was far too slow and far too expensive a method to rely on. He spent enormous time reading about business disasters, bankruptcies, frauds, and blown-up hedge funds that had nothing to do with him, purely to pull out the pattern before it ever got a chance to cost him money directly. Rule 10 was understanding psychology, specifically the predictable ways human judgment goes wrong. Late in his career, Munger gave a well-known talk called The Psychology of Human Misjudgment, cataloging around 25 distinct biases that cause smart people to make dumb decisions over confidence. Social proof, weighing a recent vivid example far more heavily than cold statistics deserve. Understanding these biases in yourself, he argued, was worth more than almost any technical financial skill, because most financial disasters start with a psychological failure before they ever become a math failure. 11th, avoid leverage, meaning borrowed money used to amplify a bet. Munger watched brilliant, highly credentialed people wreck themselves financially again and again, not because their underlying idea was wrong, but because debt forced them out of the game before the idea had time to prove itself. He pointed to long-term capital management, a hedge fund run by Nobel Prize-winning economists in the late 90s. Their models were arguably correct over the long run. Their leverage still collapsed the fund almost overnight when a short-term shock hit that the models had treated as nearly impossible. That lesson led straight into Rule 12, keep a margin of safety in every serious decision, financial or otherwise. Don't assume best case conditions will hold. Assume something eventually goes wrong and structure your finances so that when it does, you survive to keep playing. Berkshire, even after becoming one of the largest companies on earth, kept enormous cash reserves for exactly this reason, prioritizing survival across bad decades over squeezing out slightly higher returns during good ones. Rule 13 was to steer clear of extreme ideology, financial, political, or otherwise. Strong ideological attachment, whatever the flavor, tends to shut down honest thinking, Munger believed, because people stop weighing new evidence on its merits and start filtering everything through loyalty to a team or a belief they've already staked their reputation on. He tried to hold his own opinions loosely enough that new evidence could genuinely change his mind, which is rarer than it sounds, especially once someone has built an identity around being right. 14 was blunt and a little uncomfortable for some people to hear. Munger said envy, not greed, destroyed the most people financially. Watching a neighbor, a former classmate, or a stranger online get rich faster triggers a comparison that pushes people into decisions they wouldn't otherwise make, chasing returns, taking on risk they don't understand, abandoning a sound plan because someone else's plan looked flashier in the moment. He considered plain indifference to other people's financial success one of the more underrated psychological advantages an investor can have. Rule 15 was to surround yourself with people of real quality and integrity, and to treat that as a financial decision, not just a personal one. Munger's partnership with Warren Buffett ran over 5 decades and shaped both of their careers more than almost any single investment either of them made alone. The quality of the people you associate with in business and everywhere else quietly compounds or erodes your own judgment over time in ways that are easy to miss because the effect builds so slowly. 16 was rigorous honesty, treated as a practical advantage rather than an abstract virtue. A reputation for honesty opens doors money alone can't, Munger argued, because people do business with you on better terms, faster, and with less friction once they trust your word. He also thought dishonesty, even small dishonesty, eventually corrodes a person's own judgment. Since you end up needing to believe your own convenient stories, simplify. That was Rule 17. Munger distrusted complexity for its own sake, especially in finance, where he thought complicated products and strategies often exist to justify high fees rather than to genuinely serve the person paying for them. He preferred businesses and decisions he could explain the entire logic of in a few plain sentences. If he couldn't do that, he took it as a sign he didn't actually understand the situation well enough to risk money on it. Rule 18 was to stop chasing cleverness for its own sake. It's remarkable, Munger liked to say, how much long-term advantage he and Buffett got from trying to be consistently not stupid rather than trying to be very intelligent. Most financial ruin, in his experience, traced back to a handful of avoidable errors, not a lack of raw brain power. Removing stupidity from your own decision-making, he argued, was a far more reliable path to good outcomes than chasing brilliance. 19 was opportunity cost applied to every decision, not just the ones involving money directly. Every choice to buy, hold, or commit time to one thing is also a choice not to do something else with that same capital or time. Munger applied this ruthlessly, weighing every new opportunity against the best thing he could already do with the same resources instead of judging it on its own. Most people, he noticed, evaluate decisions as if they exist in a vacuum without asking what they're giving up to make them. Rule 20 was to think in decades, not quarters. Munger held some of Berkshire's core positions for well over 30 years, letting the underlying businesses compound quietly in the background while the market cycled through booms and panics around them. He treated short-term price swings as mostly noise, worth acting on only when they created a genuine buying opportunity and ignorable otherwise. That kind of patience is easy to state and remarkably hard to practice, especially when a position is down and every headline is telling you to panic. 21. Live well below your means, no matter how much money you actually have. Munger and Buffett were both known for fairly modest lifestyles relative to their net worth, long after either of them needed to worry about money at all. Unnecessary spending wasn't just a drain on capital to Munger, it was a drain on independence, because the more a person's lifestyle depends on a certain level of income, the more pressure they feel to make decisions out of fear instead of judgment. Rule 22 was managing your own ego, especially around admitting mistake. Munger and Buffett were both for owning bad, calls in plain language in Berkshire's shareholder letters without spin. Saying I was wrong, quickly and without a lot of self-defense, was one of the rarest and most financially valuable traits a person could build, Munger thought, because the alternative, defending a bad position out of pride, tends to turn a survivable mistake into a much bigger one. 23 was decisiveness once the thinking was actually done. Munger wasn't arguing for slow, endless deliberation as a habit. Once he understood a situation well enough, he believed in moving fast and fully committing. Rather than hesitating out of habit after the analysis was already finished, he kept the two phases separate, think slowly and skeptically before deciding, then move fast once the decision was made. Rule 24 was treating cash as a valuable asset on its own, not dead weight sitting idle. Munger saw a large cash reserve less as a missed opportunity for extra return and more as optionality, the ability to move the moment a rare opportunity showed up without needing to sell something else or borrow money under pressure. He compared it to keeping ammunition in reserve instead of firing every round the moment a target appears. The 25th rule tied the other 24 together. Keep learning and keep adjusting for your whole life, and never assume you've arrived at a finished understanding. Munger changed his mind on major questions more than once across his career, most famously moving away from buying statistically cheap, mediocre businesses and toward paying a fair price for genuinely excellent ones, a shift that shaped Berkshire's entire strategy for decades afterward. He treated his own past conclusions as working drafts, not permanent truths, and stayed open to revising them if better evidence turned up. 25 rules, built and tested across nearly 70 years through a bankruptcy, the loss of a child, the loss of an eye, market crashes, bubbles, a global financial crisis, and one of the longest, most productive partnerships in business history. None of them sound revolutionary on their own. That's the part people keep underestimating. Munger wasn't working from some hidden formula unavailable to everyone else. He applied ordinary discipline with unusual consistency over an unusually long stretch of time, and refused to drop that discipline no matter how tempting the shortcuts around him looked. Here's the part that's genuinely hard about this list. None of these 25 rules require unusual intelligence to understand. Reading them takes 20 minutes, living by every one of them for decades without exception. Whether the market is euphoric and everyone around you looks like a genius, or it's collapsing and everyone around you looks doomed, is a different kind of difficulty. It isn't really an information problem. It's closer to a character problem, and that's probably why so few people manage to actually do it. Even after hearing the rules laid out clearly, what runs through all 25, if you had to name one thing, is this: Munger didn't build his fortune by being the smartest person in the room, and he said so himself many times. He built it by being one of the most consistently rational people in the room, decade after decade, refusing to let fear or envy or boredom or excitement pull him off the small set of principles he trusted. That consistency, stretched across a lifetime, is what compounding actually rewards. Not a single brilliant moment, but discipline repeated so many times it stops feeling like discipline and starts feeling like who you are. If these ideas gave you a clearer way to think about your own decisions, consider subscribing for more videos on the philosophy of history's greatest investors and thinkers. And let us know in the comments which of these 25 rules you think is hardest to actually live by. Charlie Munger spent almost a century proving that getting rich is rarely the hard part. Staying rich and staying rational the entire way through is the part almost nobody manages to pull off.